All right, hi there. Today I want to talk about whether it's too late to buy Bitcoin in late 2024. My regular viewers will know how I think about cryptocurrencies in general, but I think this video will nonetheless be super insightful for both my regular viewers, for crypto skeptics and crypto believers. So without further ado, let's get started. Alright, hi everyone. So I recently came across a blog post by Ben Carlson titled, "Is it too late to buy Bitcoin?" And so I shamelessly copied that title because I thought it's incredibly thought-provoking and catchy. And let me start by, first of all, you see my board here, which helped me structure my thinking and the resources I want to talk about today a little bit. Let me first of all start by showing you the price chart of crypto over the last 5 years, which I included in my blog post on this topic, which actually went live today as well. So as you can see, over the last 5 years, Bitcoin has performed tremendously well. I think over the last 1 year, Bitcoin is up 115%. No, let me correct me here. I think that's over the last 12 months. And over the last 1 month alone, so basically ever since President Trump was elected again, Bitcoin is up 36%. And whenever an asset class or an investment performs tremendously well over a relatively short time period, people get interested. And that is something we are witnessing right now as well. So this is how Ben Carlson started his blog post as well. He was quoting a reader of his blog who sent him a question. And that reader was asking, quote, "I'm thinking of adding Bitcoin to my portfolio via one of the new ETFs, but it feels like I've already missed the boat with the insane run-up this year. Is it too late to add? I don't want to be a muppet." And what I will say is that this question nowadays is certainly not uncommon, both in the world of investing, but also in the world, quote unquote, outside of investing. People more and more talk about cryptocurrencies and Bitcoin in particular. So what I mean by the latter is that, at least in my social circle, I hear more and more people talk about the opportunity in Bitcoin, cryptocurrencies as an asset class, from people who usually don't have much interest in investing in general. So I would say Ben Carlson is certainly not the only figure that is well known online when it comes to finances, personal finances and investing that gets sent these questions. And obviously I have a couple of thoughts on this as well. So let me start by saying that obviously whether it's too late to buy a Bitcoin right now depends on two factors primarily. One would be your risk appetite and the other one would be your investing strategy. What I would say, and this is what my regular viewers will sort of anticipate, I guess, is that you have to realize that Bitcoin is a speculative asset. It's a non-productive asset, which means there is no underlying value that the price of Bitcoin is tied to. This is why, and this is what Ben Carlson later points out as well, this is why the price of Bitcoin could continue to go up, of course. It could hit 100,000 soon. It probably will. It could hit $1 million relatively soon. Who knows? Maybe next year. It could hit $10 million. It could hit $10 trillion. Really, there is no limit to the price of Bitcoin because there is no underlying value. But at the same time, this also means that Bitcoin could go to zero. And here I want to contrast speculative, non-productive assets to productive assets, meaning assets that actually produce tangible benefits, such as cash flow. Think of real estate or businesses, aka stocks, for example. If the price of an asset, of a productive asset, say of a business, the price you could acquire an entire business for drops by 50%, the expected return, assuming all else equal, meaning the business didn't deteriorate fundamentally, the expected return just went up, which means eventually there will be more buyers for this asset, driving the price up again. Think of Meta platform, for example. Obviously, there was a period during which everyone was very scared. The price, I think at one point it was down 70% from the previous all-time high. But at some point, people said, that's enough. Meta is now trading at 6 to 7 times the cash flow produced by the core business. That's just too cheap. I think we are going to earn a good return from here. And basically, ever since, the stock is up almost 6x, or maybe more than 6x. But that's not true for speculative assets. So what I would say is, generally speaking, I would weight my speculative investments. If I want to make such bets, I would weight them accordingly in my portfolio, meaning I would make them smaller positions, speculative positions, being fully aware of the fact that this is not part of my core investing strategy, which should be based on rigor, analysis, and valuation. So to get back to Ben Carlson's quote, so what he's concerned about is that this particular reader who handed in this question, that he's making that decision mainly driven by his emotions and one particular bias that we'll talk about in a second, and not so much based on analysis work. So he wrote, if you weren't interested in Bitcoin at 20K, 30K, 40K, 50K, 60K, etc., I would be concerned if it's only appealing to you now at 100K. That's not to say it couldn't work out for you. The price might keep going higher. No one knows how high Bitcoin will go. When it's on a heater like this, you could certainly make some money riding the momentum train. But my biggest concern is this. Why now? So the bias he's talking about here is the fear of missing out. And even the best investors in the world, the smartest, the brightest people in the world, they suffer from our emotional biases. And oftentimes when you make decisions driven by emotions, in the world of investing, this is to the detriment of your overall returns. That's very important to be aware of. So for example, in this blog post from Ben Carlson again, he starts by referring to the anecdote of Isaac Newton, which clearly was one of the brightest minds ever lived on Earth. But apparently during the South Sea bubble, I think at one point he sold his investments at a nice gain, but then things continued to go up, and at some point he couldn't take it anymore. So he bought back, and he bought back pretty much close to the top, lost a ton of money. And now you may say, well, Rene, Isaac Newton, he's not really known to be a world-class investor. Let me present another example here to you, which is Stanley Druckenmiller. On various occasions, he has shared the anecdote that during the dot-com bubble, he made a crucial error. I think in the clip I'm about to show you, he refers to it as maybe the biggest mistake he ever made, because he made a decision based on fear of missing out. So actually I want to show you that clip real quick. So here we have an interview with Stanley. Here we have an interview with Stanley posted by the Reflexivity YouTube channel. I'll link it in the description down below. And let's just listen to what he had to say.
My first boss had this saying, the higher they go, the cheaper they look. There's something weird, and I know everybody watching this has experienced this, and it doesn't make any sense, but when a security goes up, every bone in your body wants to buy more of it, and when it goes down, you're fighting making yourself not sell it.
So what's funny here is that as an investor, you will know that feeling all too well. Price drives narrative. When the price of a security goes up, or of an asset in general, you will feel very good about it. You will not be worried about what could happen to the underlying business. In the case of stocks, for example, you're just enjoying the quote-unquote sweet gains. However, on the flip side, if prices decline and they decline significantly, all of a sudden you start to worry. And that's not really the mindset you should approach investing with. You should actually try to act and think counter-cyclically, so to speak. So when everyone is bullish and excited about investing, that would be the time to start becoming skeptical. Think of Warren Buffett, for example. I recently made a video on his cash position and how his cash position is sitting at a record high on a relative basis. That's sort of counterintuitive right now, right? The S&P is up like 35% for the year or so. Everyone is excited about stocks. Stock ownership levels in the US are, I think, at pretty highs, maybe not record highs, but certainly close to it. And this is where Warren Buffett starts accumulating cash. So he is really aware of trying to act counter-cyclically, as I call it here. Let's continue with Stan.
Right. It's just the nature of the beast. And you have to constantly remind yourself why you own that security. And just because it's going down doesn't necessarily mean you should sell it. If it's going down, it definitely means you should reevaluate your thesis, but it doesn't mean you should sell it. And you cannot get crazy when it's going up. One of probably the biggest mistake I ever made in the business, and I knew better. Somebody asked me what I learned from this. I said, nothing, I already knew it. In January of 2000, after riding that tech boom to a T and making billions of dollars in 99, I sold everything out in January. And I had a couple of internal portfolio managers at Soros who didn't sell out, and they had it was a smaller portfolio, but they made 30% after I sold. and I just couldn't stand it anymore. And I'm like watching them make all this money every day. And like for 2 days, I'm like ready to pick up the phone and buy this stuff back. And, you know, there's a little devil there, and then the angel, and she's saying, don't do it. And he's saying, buy it. And I pick up the phone and I buy them. I might have missed the top of the dot-com bubble by an hour. I ended up losing $3 billion.
Oh boy, losing $3 billion back in 2000. That must have been very painful. So there you have it, even the best investors in the world. And even though Druckenmiller is following a very different philosophy than I do, more macro, more momentum driven, I nonetheless believe that his performance speaks for himself. And as he points out, back then he was already very aware of the different biases influencing his decision making, but he couldn't hold himself back from getting back into the market due to his emotions and his biases, to his detriment, of course. So I want to wrap it up here by referring to two more things. So first of all, what also made its way on my dashboard is this tweet by Thomas Juror, in which he talks about the tulip mania. So I think the tulip mania, and I'll get back to this in a second, is another example of how rising prices can lead to many people making emotional decisions that are no longer based on rational logic. But I'll get back to that in a second, because another tweet I put on my board here is from Theo Burkhardt. And in it, he was talking about overconfidence bias in particular, but to back up his thesis that he lays out in this tweet, he was making a distinction between the weight of evidence and strength of evidence. So one would be, how strong is the evidence? If you flip a coin 10 times, that's the example he uses, well, and 7 times it ends up on tail, well, that's sort of a strong evidence, right? That's a 70% rate. However, the weight of the evidence would be, how often did you flip the coin in the first place? How big and reliable is your sample size? And if you only made 10 coin flips, the sample size is pretty small. And we just, because we know how coin flips work, we understand that the actual probability is not 70-30, but 50-50. And that over time, the more flips you do, we should get closer to that result. But what he's then saying is that with regard to other decisions you may have to make in the world of investing, for example, is Bitcoin going to continue to go up, for example? We don't have that big sample size, and we can't really rely on intuition here or our prior knowledge around the world. So obviously over the last 10 years, the signal, so the strength of evidence that Bitcoin is a well-performing asset class has been very strong. But is the weight of evidence strong too? I don't know. That remains to be seen. I would say Bitcoin is a relatively young asset class still. It's not as established as gold, as another non-productive speculative asset class, for example. I would argue that at least in the near and medium term, we have probably hit critical mass, meaning I think there are enough people believing that Bitcoin has value, even though I'm convinced it doesn't, that there is probably a floor to the price of Bitcoin. However, over the long term, I'm not sure if that is true. And that brings me back to the tulip mania. So tulips too were non-productive assets. Nonetheless, people were willing to bid up prices of tulips to prices that were exceeding entire houses. So that's crazy if you think about it today. And it remains to be seen whether we are going to think back of Bitcoin 20 years from now the same way. All right, that's it for today. Let me know whether you agree or disagree with me here, whether you think it's too late to buy Bitcoin, whether you own any crypto in your portfolio. And so that's it. Take care. See you in my next videos. And make sure to read the blog I referenced. So my blog I referenced in the video, because I share some more insightful takes in it. Bye.